Options Trading, the definitive guide to earning passive income through options trading, including strategies on binary options, futures, ETFs, financial leverage, and much more. Written by Joseph Mallardh. Narrated by Nick Palmer. Chapter 1. History of Option Trading. Many individuals believe that options trading is a comparatively fresh type of investment, especially when compared to more traditional types, such as purchasing stocks and shares. Modern options and contracts, as we understand them, were only really implemented when the Chicago Board of Options Exchange, the CBOE, was formed. But the basic notion of option contracts is thought to have been created in ancient Greece, potentially as long earlier as the mid-4th century BC. Since that time, options have been around in one form or another in different marketplaces, right up to the formation of the CBOE in 1973, when they are properly standardized for the first time and options trading gained some credibility. On this section, we provide information on the history of trading options and alternatives, beginning with ancient Greece and going right through modern day. Some of the topics we'll be discussing are olive harvest and thales, tulip mania in the 17th century, bans of options trading, put and call brokers in Russell Sage, the listed options market, and the evolution of options trading. Olive harvest and thales. Aristotle, a Greek philosopher of great influence and a writer on many subjects, referred to the earliest recorded example of options in a book written in the mid-4th century BC. Aristotle included in this book, entitled Politics, an account about another philosopher, Thales of Miletus, and how he benefited from an olive harvest. Tulip bulb mania in the 17th century. Another relevant occurrence in the history of options was an event in Holland of the 17th century, which is widely referred to as tulip bulb mania. Tulips were incredibly popular in the region at the time, and were considered symbols of status among Dutch aristocracy. Their popularity spread throughout Europe and the world, resulting in a dramatic increase in demand for tulip bulbs. By this point in history, calls and puts have been used in many different markets, primarily for hedging purposes. For example, tulip growers would buy puts to protect their profits just in case the price of tulip bulbs drops. Tulip wholesalers would buy calls to protect against the risk of rising tulip bulb prices. It's worth noting that these contracts were not as developed as they are today, and options markets were relatively informal and completely unregulated. Demand for tulip bulbs continued to rise during the 1630s, and as a result, the price also rose in value. As a result, the value of tulip bulb option contracts increased, and a secondary market for these contracts emerged that allowed anyone to speculate on the tulip bulb market. In Holland, many individuals and families have invested heavily into such contracts, often using all of their money or even borrowing against assets such as their property. The price of tulip bulbs continued to rise, but it can only continue for so long, and eventually the bubble was busting. Prices had risen to the point where they were unsustainable, and buyers began to disappear as prices began to collapse. Many of those who risked everything on the price of tulip bulbs that continued to rise were completely wiped out. Ordinary people had lost all their money and homes. The Dutch economy has gone into a recession. Because the options market was unregulated, there was no way to force investors to fulfill their contract obligation options, and this ultimately led to options gaining a bad reputation around the world. Bans on option trading. Despite the bad name that contracts of options had, they still appealed to many investors. This was largely due to the fact that they offered a great leverage power, which, in fact, is one of the reasons why they're so popular today. So the trading of these
Sample complete. Ready to continue?